Hey, welcome back. Swift just put a blockchain ledger in its stack. The SEC has 16 ETF deadlines looming this October, and Michael Saylor say OG sellers are stepping aside while institutions prepare. Capital is resetting right now. I'll show you how this week's moves could rewire where trillions flow into Bitcoin and tokenized assets. Well, this tweet on X shows that $15 billion in Bitcoin shorts is set to liquidate once the Bitcoin price reaches $120,000. Now, a short means when short-term traders are trying to place their bets on the continuing downward sales pressure on the price of Bitcoin, i.e. trending downwards. Whereas long positions are on the upside. So whenever we receive a signal like this, where there is a massive short squeeze or liquidations on Bitcoin or indeed other digital assets, because there's going to be more momentum and push towards the upside price of Bitcoin. And once that happens, well, naturally, all of these short-term day traders that have leveraged positions on the shorts on Bitcoin, i.e. trending downwards, well, they're going to be squeezed out of the market. That's what the terminology short squeeze means, because the tendency now is for the price of Bitcoin to rebound and surge in an upward direction. It says that roughly $15 billion worth of Bitcoin short positions are positioned for liquidation once Bitcoin's price hits $120,000. Now, the looming squeeze highlights the potential for accelerated upside if the market pushes through that key level, the $120,000 level. That's what I've just explained. So this is just another bullish sentiment that we're going to be certainly seeing between now and the rest of this year at a minimum for the price of Bitcoin to hedge its way upwards. Another interesting tweet that I regularly follow shows the seasonality of the movement of price of Bitcoin in the previous cycles. It says that when September closes green, if you look in historical context, it says that Bitcoin tends to keep rallying for quite some time. If you cast your minds back in 2015-2016, according to this table, it says that after September, it usually follows with 3 more green months, as shown in this rectangle here. In 2023, mind you, again, there were 6 more green months. If you look at 1, 2, 3, 4, 5, 6, starting in October 2023, all the way through to March 2024. That's the 6 more green months it makes reference. And then the last one, 2024, last year, there were 2 more green months, 1 and 2, October and November 2024. So we should expect 2025 to be much more. We've just seen 3.2%. If this was the trend in previous cycles, we should certainly see more bullish green months in the months moving forward from October next month this year. We're going to be seeing more increased acceleration, accumulation into Bitcoin, and the scarcity effect is slowly but surely going to become more felt. It's going to be even more shocked supply in the coming months and years ahead. So this is just yet another bullish sentiment that we are heading in the right direction as per our expectation. Now I move on to the next interesting article from Michael Saylor. Now, you might have seen that he's introduced what he's calling the denominated Bitcoin-backed credit, right? Now, this is the latest novelty of Bitcoin-related products. Now, if you cast your minds back, we've got the ETFs, which were the entry point for those institutional players to add and get some underlying exposure to Bitcoin by purchasing these wrapper instruments, these ETFs from BlackRock, Fidelity, and so on, right? Now, in addition to that, we have Bitcoin treasury companies and indeed digital asset treasury companies, another way or wrapper around how they could actually include their Bitcoin underlying and digital underlying into the balance sheets. And the latest novelty now that we're seeing is Bitcoin-backed credit. This is another way, in effect, to provide yield on the actual Bitcoin collateral, because the actual gap in the market that we've seen, and I made 1 or 2 videos about it, that I'm a Bitcoin holder. At the moment, I have majority of my holdings under self-custody, like my Ledger device, Trezor device, which are the hardware wallets. I'm not actually getting any yield for it. I'm just banking on the fact that the price of Bitcoin will always go up in exponential. But in the meantime, I'm not getting any additional yield or premium as a result of me holding on to my Bitcoin holdings. Now, this is the gap that Michael Saylor has spotted, not just for institutions, but for the rest of the retail investors, is in effect how we can still retain our Bitcoin holdings and use that as collateral to get the yield, to get the, let's say, the additional interest as a result of holding on to our Bitcoin holdings. That is what Saylor has done through this Bitcoin-backed credit. Now, his company called Strategy has issued some preferred stock instruments. There are 4. I think there was Strife, Stretch, Strike, and I can't remember what was the 4th one. But those are the 4 Bitcoin-backed credit instruments that he's issued into the marketplace. And really, as I said, Saylor is arguing that the OG, the original gangster holders of Bitcoins, are selling very small amounts, and institutions are preparing, signaling a maturation phase where volatility is expected to ease while institutional accumulation builds up a durable base. Now, we need to watch out for some additional product announcements from Michael Saylor and Strategy firm, because they're always into innovating new financial products linked with Bitcoin collateral. And indeed changes in realized volatility, because we should expect the volatility for Bitcoin to smooth out, because there's going to be a huge capital base that is growing, which would reduce the rate of volatility over time. So very interesting times ahead, and we should certainly watch out for these Bitcoin-backed credits. And as a word of caution, if you really want to invest into this space, you need to do your research, and you need to ensure yourselves that these security firms that are offering these Bitcoin-backed collateral loans or credits, that they are registered security firms in the jurisdictions that you live. That will be my first advice, in addition to reviewing the product literature, the interest rates that they have actually signed themselves up to, so on, right? So very interesting times. Another interesting topic, which is around Bitcoin's quantum shield, it says that industry rushes to fortify against future cyber threats. Now, I've made a deep dive video on this topic, which will explain in detail the latest novelty and announcements and innovation that's happening around building up post-quantum cryptography for these blockchains. So just need to watch out for that release, which I advise you to watch. Now, going back to this article, we're in this quantum era where cryptography risk is upon us and is now being addressed industry-wide, which forces long-term protocol work like the post-quantum cryptography, address migration that could certainly change custody, wallet flows, and institutional risk models. So in effect, we are seeing a lot of industry standards body like the NIST, who are working on a 24/7 to come up with more robust cryptography methods, cryptographic algorithms, to help strengthen the Bitcoin network and other blockchain systems. So it's very good news. And as I said, just watch out for that deep dive video on this topic where I actually explain in a little bit more detail what are those innovations going to look like. So watch out for that release. Right, another interesting article here, which is, I wasn't expecting for this to come out. It was like out in the blue announcement from Swift, where it says it's intending to add blockchain-based ledger to its infrastructure stack in a groundbreaking move to accelerate and scale benefits of digital finance across more than 200 countries and territories worldwide. Now, just a recap, this is actually in direct competition with what XRP is intended to achieve. So if you cast your minds back, the value proposition behind XRP is to act as that plum infrastructure where it's trying to bridge the institutional players in TradeFi into the blockchain systems on chain. Now, we are seeing that Swift is open up their eyes and say, hey, listen, we can't let the XRP be the predominant play in this space. We need to step ourselves in, which is precisely what Swift has done through this announcement. So we're going to be expecting to see Swift integrating a blockchain-based ledger, bridging the TradeFi into the digital rail system. So this should enable to lower frictions for tokenized assets and cross-border RWA settlement at scale. So again, this is a direct competition to the likes of XRP, but we're going to be seeing Swift to really step up their game and get into the real-world assets tokenization space. Right, then moving on to the next article, around which it says here October is dubbed as the ETF month, where we're going to be seeing the US SEC, the Security and Exchange Commission, which is a financial regulator in the US, is poised to make massive decisions around approving or not the 16 pending crypto ETFs. Well, it's an important month for October because there are 16 crypto-related ETFs at stake here, where they've actually filed all of their crypto ETF filings to the SEC for them to review and consider and make their final decision to whether approve these or not. Now, we're not just talking about crypto ETFs for Solana and XRP, which are obviously the top ones in the list, but there are also others out there for Litecoin, Dogecoin, Cardano, and even HBAR. So this is all going to happen in October. It wouldn't be at all surprised that it's going to be a clean sweep approval across all of these 16 crypto ETFs, which would open up the wave of approvals or possibly some rejections, but will reallocate trillions in institutional and retail capital via on-ramp funds. So it's going to be very interesting times, and we should expect to see some important announcements later on in October on whether all 16 of these crypto ETFs will be approved by the SEC, or maybe one or two may be rejected. So we need to watch out for which ETFs have been approved at the end of the day and see the initial inflows and outflows into the ETFs. I have a tracker on that, so I'll be able to go through that. So we need to find out whether these approvals will actually favor the existing Bitcoin spot ETF products only or include alt. So it's a rather important month for October to watch out for. Right, let's go back into a couple more articles in the RWA space. Now, Plasma is trying to merge the narrative between Bitcoin as a collateral and Tether as a stablecoin. So you remember I made a couple of very early on videos explaining the dichotomy between using Bitcoin as a store of value and not use it for medium exchange purchases on chain, and use stablecoins for that. So I've always made that distinction between Bitcoin as a store of value and stablecoins as a medium of exchange. Well, this is precisely what has happened. Plasma has entered the space where it's trying to join up these two dichotomies into its Plasma offering. So it's completely redefining Bitcoin as the base reserve, while stablecoins assume more of a payment layer, which enables between them to provide more capital efficiency improvements and tokenization rails. So very, very interesting offering. This is something that I've always anticipated would happen, right? Because it just doesn't make sense to spend your Bitcoin to buy a coffee where you can use Tether for that, right? So really is a very interesting times ahead. A lot is going on. It's not just within the classical macro Bitcoin space, but also the real world assets. It's starting to really elasticate itself and include a lot more momentum and innovation and product offerings and blockchain tokens into the space, right? This is part of the thesis and expectation for this year 2025. That is the major catalyst where we're starting to see other non-Bitcoin real world asset tokens starting to take off. And this is just a testimonial that we're heading in that direction. And my last article is still within that real world assets innovation. It's called ACX. Now, ACX is becoming the first world's real world asset tokenization for emission projects. It says that the ACX launches real world asset tokenization platform for emission reduction projects, which will help tokenize environmental assets as investable RWAs, attracting ESG capital into crypto rails. So very, very interesting. And again, this is the trend that we are seeing. The real world assets tokenization is set to be poised as a multi-trillion-dollar industry by 2030, 2035. If you remember, I made a couple of videos where I've provided estimates from McKinsey, Boston Consulting Group, that between them, they provided their own estimates around $16 trillion of real assets industry between 2030 to 2035. So it's no surprise that we're going to be seeing more launches of these RWA coin projects coming out. And this one in particular, I think is very, very interesting because it's something that may resonate to quite a few people out there. So anything that would help protect and reduce the carbon emissions, and anything that would help digitize and tokenize those efforts and projects on chain can only be a good thing. So I think for me it's one of the most interesting RWA coin projects that we should place a close eye of attention. So we're going to be seeing more carbon emission related tokens coming out in the RWA space. So just to round up today's episode, these aren't isolated headlines. SWIFT, ETF rules, institutional accumulation and tokenized RWAs are the threads of the same story. The plumbing of finance is shifting towards token rails, and where the rails go, capital will follow. So if you enjoyed today's episode, please don't forget the like button, to share the video to colleagues, friends and family, and if you haven't done so already, so please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, blockchain technology and the future of finance. So until next time,